Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name's Seth Crustman, joined here once again with Ben Brachon, Dan Mickelin. How are you guys doing today?
I'm doing great. How are you doing, Dan?
Doing really good. Glad we ducked that snow and, ready to enjoy a great show here.
Absolutely. Absolutely. What you got, Seth?
I've got sunshine. Now that we're talking about the weather. Sunshine about 30 degrees. It's been absolutely beautiful here. Thank you for asking.
Overcast, rainy, and a little bit of snow.
Yeah. And a good fall, though. It's been nice.
Yeah, we're happy to be here with you guys today, and we are going to be talking about safest. This is actually all of these are conversations for everybody. If you happen to have a pulse, folks, then guess what? You're probably out there using money, saving money, investing, whatever it is. It matters to you. It matters to your retirement, and that's what we talk about here on Money on Tap. We talk about three-dimensional investing. Why wouldn't we want to talk about, the stuff that's, in the market and super fun and exciting, as well as the stuff that maybe is, a little bit more on the subdued is typically where people might think. But it is exciting still because what can happen inside of a retirement for you when taking a look at safer, and safest types of investing is phenomenal. Absolutely incredible.
Yeah, I think with the kind of ever-changing environment, especially with rates rising at the fastest pace in history, this is definitely offering different types of opportunities. Fast change like this, kind of exploits one and maybe harms another, from an investment perspective. And so those conversations continue to rise and they kind of bubble up on all different levels with clients and, cocktail party kind of conversations. You meet somebody at a barbecue or whatever, that there's always that event, that conversation. Hey, this is happening in the market and that happened with the rates. And what are you guys doing? What are you guys talking about? That list is endless. There's an endless number of things we can talk about in different needs from, investment objectives, risk tolerance, how long do you have till, you need the money or how you can invest it. So those kind of like steer the real ship itself into where the conversation is. But from an investment perspective, there's a lot inside the world of, the safe money investment conversation, especially with rates going up. People are going to the bank and they're seeing CD rates at a much higher rate than they've ever seen before. Well, at least in decades, like plural, maybe 3 or 4 of them. And so people are starting to say, boy, I was hoping to have that rate of return and maybe my portfolio would have been nicer this year than what the stock market's done for some people. So there's a lot of conversation about where to invest your money now with the change in rates. And I think we're going to try to tap a little bit into that conversation today, and I'm excited about it.
It's interesting, as we're just kind of getting prepared for the show. I think one of the fallouts about this whole pandemic thing that we'll all realize clearly, 10, 20 years from now, is that how that influx of stimulus created all these little bubbles, right? The first was the equity market, which kind of came and went, and the air let out of that. Then it was in real estate. Maybe that's what's happening in kind of the fixed rate world right now. We've had coming off a historically low rate environment. People had all this short-term success in equity investing and real estate investing. Now they're getting scared as the tables have turned. Maybe they're pumping all that money into the fixed rate world, and we're soon to return to more of what kind of our recent historical averages have been. And this might be an opportunity to take advantage of, artificially inflated rates.
Wow, folks, I'm holding back. The stuff that you guys are talking about, I'm like, ooh, I cannot wait to get into this conversation, but it's going to be down the road a little bit after we do Money in the News. So, Ben, you were talking about fast change exploiting one part of the market and making changes in another, and some of those things possibly coming up or popping up at dinner parties. Well, it just so happens that the dinner party of all dinner parties this year, Thanksgiving, is going to experience that in a cost of about 20% more this year because of inflation. Thank you, Vanessa Yukovic from CNN, for bringing that to the table for us today. 20% increase on your turkey across the board. Now, that sounds to me a lot more than the 8% that we've been hearing about in inflation.
Yeah, and the article breaks it down by, kind of items at the table, right? I thought that was pretty interesting. So a feast for 10 to 12, including turkey, stuffing, cranberries, and pumpkin pie mix, will cost $64.05, up $10.74 from last year, which breaks down to $6.50 per person, which actually sounds like a pretty decent deal to get all that food out for a crowd like that. And that includes the average price of a 16-pound turkey at $28.96, which is up 21% from a year before.
I've never had a better reason to tell people that we can't have them over for dinner. Thanks, family. See ya. Sorry, we've had a 20% increase. It's costing me a significantly larger amount of money to have you over, and this is the best excuse I've had in a long time. We're suffering.
It's second to the code in California, right, during the pandemic. You couldn't have more than 8 people at your table or some ridiculous notion.
We were thinking about moving to California just to create the limitation.
Something tells me you wouldn't have adhered anyway, Ben. I don't know.
Ben, normally you're one of the most generous people I know, but I think the truth is your generosity ends at the Thanksgiving table.
Absolutely. Absolutely. You get out, not enough turkey. Actually, Thanksgiving is my favorite holiday by far, number one. And it's funny because I was talking to my son, and he said that Thanksgiving was his number one holiday, and then was debating with all his roommates in college because they said Christmas was, and he was like, well, you guys are all greedy. He said, I just enjoy eating and then falling asleep on the couch, which is exactly my number one.
I think perspective changes on that, immediately when you lose your position in the gift channel, right? If we go from just receiving to just giving, right? Christmas moves down the list, Thanksgiving pops right up, but nothing better than food and football. And this year we got the Patriots on at the night game, which is going to be a big plus. So I'm all kind of excited already.
You nailed it with football. It's kind of like, which of the sports do you prefer, football or basketball? And I'm just going to go all in on the football scene.
Hands down.
I think the thing that's really, I was actually, when we was reading this article, one of the concerns that came to my mind as I was actually processing that was the number of donations that go to, food banks and stuff like that, and charities and the pantries that do this stuff, and the increased cost for people to actually provide. It's fortunate that we have we don't have a problem putting turkeys on our table, and we enjoy Thanksgiving with our family. And there's a lot of people that don't have that opportunity, both from a personal standpoint, but from an affordability standpoint. And I am concerned because, the price of food is up 20% and people are struggling. And so, the gifting side of this thing is a concern for me. And it just was just interesting as I was thinking through the cost, because it is astronomical to really understand what it is to see the price of food go up 20%. Now, when you break out the numbers and the cost of $6.50 per person, that's one thing. But to think of something going up 20% in a year, well, that might be a one-time, hey, inflation's been low for a long period of time and so forth. But if we started engaging this at a 2 or 3 or 5 year stint, like, people would really start cutting back, like in ways that we've never seen before. And I think that's, what's interesting. And you were referencing an article, and it actually brings us right into the next one. So before I jump, go ahead.
And next up, we have an article here coming to us from Fox Business. Credit card balances see the largest jump in more than 20 years, the largest annual jump. So household debt has really surged in the last year. Inflation's obviously a huge tie into that. The cost of living, the cost of goods, everything has just gotten more expensive, holidays included. So unfortunately, even though wages have been up, people are, not able to make ends meet the way they were. And rather than kind of leave some things behind or kind of lighten up on the lifestyle, they've, very clearly chosen to buy on credit, which is something in a raising rate environment like we're in is really a substantial risk for many households out there.
One of the things to take a look at there with the rising amount of credit that's out there, you'll start to see the credit markets tighten up because the risk is increasing with the more that they're carrying on those balance sheets, and they're also becoming more profitable on those dollars. However, they will start to open up some opportunities for people that do not carry a lot of credit or balances on their credit for some favorable credit terms. So just some opportunities to look at if you're paying attention to that.
Yeah, I was going to, and then what I was going with earlier on some of this stuff is like the conversation we had with Jeff Bezos saying, hey, listen, we're walking into a recession. Stop buying TVs, stop buying cars. And he was referencing the amount of, credit card debt in our country and what's going on right now. And, looking at Thanksgiving costing 20% more, people are still going to have Thanksgiving and be like, I'm going to put it on the credit card. It's a holiday. We're going to still have our family over, and we're going to maybe have a smaller turkey and a lot more mashed potatoes. That's kind of how my family worked. It was, very small bird and a lot of things out of the garden. So that's, it's very, very concerning with how these things are moving, because we're seeing the translation of these exorbitant new costs, translating to credit cards, meaning people can't afford it.
Yeah, when you buy on a credit with a 20% rate attached, those are decisions that you really have to weigh carefully, because it ends up being, and I think everybody understands this, what you end up paying for that item isn't the price at the checkout counter. It's going to be significantly more over time with rates like this.
As interest rate goes up, guess what? Credit card rates do too. Oh yeah,
yep, very quickly, and they're slower to come back down too, if rates do ever stabilize. So, yeah, think of things that way. It's if you're making a purchase on credit and you don't intend or don't have the ability to pay it off, at that next statement, just really put a little bit of thought into realistically what is this actually going to cost you, and is it a purchase you have to have right now?
Yeah, smart financial management is going to become a major player over the next 5 years as we deal with inflation and recession.
Absolutely.
So,
yeah, you actually just got me thinking about an idea there for people that have some of these skills out there and understand how these markets work. There's people that need help. They don't understand it, and there's a niche there for anybody out there listening or knows somebody that's able to step into personal finance with people and help them really reduce some of these extra costs. You see apps doing it right now, like with, reducing some of the, subscriptions and stuff like that, but just on a different level. Hey, I was happy to bring this article to the table this week by Ben Hooper, and it has to do with Steve Jobs. If any of you remember Steve Jobs, well, he was pretty well known for his attire. It was the same thing every day, no matter what. And part of that was a pair of Birkenstocks that just got auctioned for more than $200,000, folks. I would love.
Not everyone's worried about the inflationary issues.
Yes. I think Turkey at that table is doing all right. Whoever.
There's no mashed potatoes at that table.
No. Fine dining at its best. And, you'll have a new centerpiece and new something to chat about at the table. And this pair of worn Birkenstocks, which is just incredible that people would pay that kind of money for, a pair of used shoes. Is really what it is.
Well, and an NFT, or whatever it is, something about that thing is going with it. I'm not even sure because it doesn't get into it. But there's a lot of weird stuff out there. I mean, I think the disparity in money has just gotten greater over the last 5 years with COVID and all the money that's been pushed out and so forth. It's just like, it seems to be sitting in some of the wrong hands.
Yeah, there's no doubt about that.
I was kind of curious if this was just kind of a one-off for whoever bought these, or if they actually have some kind of like maybe a Steve Jobs shrine, or, you go into like their creative room in the basement that, typically, I'm thinking of the man cave that typically has like, the pool table and, sports stuff, memorabilia all over the place. Maybe they just get put on the wall in that room, or maybe it's like a totally different vibe when you walk in. It's weird either way. I don't know. Folks, that's going to do it for us in Money in the News. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about safer, safest. That's what's on tap today with us. We'll be right back.
Hey folks, Seth Cressman, Brayshaw Financial Group is our company, and we bring to you Money on Tap. I say we, that's Ben and I. We have a lot of fun doing this show. And one of the things that we love about doing Money on Tap is that our goal for you to have access to the financial planning world. How do we think? What are we doing? What are we talking about? Raising the bar of your financial education. It's so critical. And that's what we're doing here. The other side of this is as well, we're financial planners. If you are looking to work with a financial planner, if you want to have that playbook for you to understand the important things right now and how you're going to get to your goals or how you're going to retire successfully, that's what we're doing as well. If you have $250,000 of investable assets, give us a call. It's free to you, and it is worth your time to pick up that phone and give us a call and discover what complete wealth management looks like. Ben and I are excited about the opportunity to partner with you and give you that financial plan that's going to make the next step so much better understood and get you where you need to go.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about safe, safer, and safest this week. And it's a conversation that we continue to have throughout our financial planning experience and with our clients all the time. If you're in the market or have been in the market, you've experienced something that is pretty normal, and that's a pullback, right? And you're also experiencing something in the economy that historically happens as well, which is inflation. And the two of those have really created a situation where there's a lot of fear around the protection of assets and how do I protect assets and still get a return. And then there's also a conversation around opportunity, because there will be opportunity as things ebb and flow. And the conversation that we're having today, believe it or not, is a part of your questions to us. How do we do what we need to do right now? What are the pieces of our portfolio that we need to take a look at protecting, and how do we do that the best way possible? And guess what? We're not here to put slap a sticker or a rubber stamp on any of the information here today. That's just not appropriate. It's a conversation that we have, and we're going to go ahead and bring it to the table with you. And it's going to be fun. We're going to have some fun with this one.
I think it's a great point, Seth. And I think we said it earlier. I'm going to say it again. It's how much time do you have? What are you trying to accomplish? And what kind of risk are you willing to absorb, right? And there's always a portion of low risk or no risk investing in everyone's portfolio. So this is a topic as we kind of go through, safe investing or safer investing or the safest investing that, may or may not be what you want. But I mean, the truth is that, you could have cash sitting in your wallet and it could be decreasing in value as we speak. And I think the general public doesn't really kind of follow that train of thought. The fact that, I've got the U.S. dollars and all of a sudden the U.S. dollar starts losing its strength. And when I go to Europe and I'm traveling, all of a sudden that money's not worth as much, right? And so people don't really understand the concept that, whatever asset you think is perfectly safe is always in flux. There's always transition occurring in its value. So I like the title of this show, and I really like, Dan said something earlier. I hate to give Dan credit. It's just like this thing about giving Dan credit for like great statements. But all these micro bubbles, Dan, what a great what a great concept of really kind of explaining, how the world will see all the different, pieces that have happened and how that flux has just been amplified in so many different places, including the U.S. dollar for that, And so that is just really kind of drives the conversation of what is safe too, and kind of how to mitigate that. There is so much going on in safe money and safe money management, and with the change of rates, it's literally a changing environment as we speak. And we're waiting for the Fed to raise rates again. People think it's going to be a half a percent, could be 3/4 again. It's still the highest rate raising period in history. This will go down. I mean, everyone loves to be part of history. They'll be talking about their stupidity at some point in time, I think. But crashing the U.S. economy is, I think, what's going to end up happening here at some point. And that's scary. Recession's scary. And it's something that's, like Bezos is saying, be prepared. It's coming. Is that happening? It could be. And so that makes this conversation today and this show today probably one of the most valuable shows for you to listen to.
Yeah, I think it's there's always a balance going on back and forth here. I mean, there's a lot of indications that would lead you to believe that inflation has cooled off and is maybe starting to recede. A lot of the investment management side is pointing to that and doing so with a hopeful eye towards the Fed easing up on their kind of rate scheme here. But when you hear from the Fed directly, they'll give you no such indication. They're still full steam ahead, going to keep on raising until they're satisfied. And you got to wonder sometimes, what indicators is everybody looking at here? I mean,
well, they're looking at the rates are going. The rates are dropping. They're seeing a slight drop, but it's not anywhere near where the Fed wants to see it.
No, yeah, but these things take time, right? So I think the investment world is saying, hey, let's ease up on the increases. Let's see if this thing has had, if the Fed action has had the effect that we hope it has. And their perspective is that it takes time to, come to the point of realization: is this working or not? And just continuing to crank up rates. In the meantime, we're just going to go drastically too far in the wrong direction.
Inflation is always a trailing indicator. We made that point in a number of different shows. So if it's a trailing indicator, we're not going to know until after. And I think everyone is just saying, give it another few months. Let's see if it continues to decline. Are we at a point where it's already sending us in the right direction fast enough that we don't need to amplify it any further?
Yeah, the Fed's, I think their mentality is, well, we can always lower rates later. But, well, how many trillions of market cap are we going to lose between now and then, right? So it's a delicate balance.
How much interest are we going to pay? Because every time they raise rate, or the interest rate the U.S. government pays, and we were talking earlier before the show, is a third of our national debt. I mean, a third of our national budget. So, you think about just the debt we pay. It's a third. It's crazy. And so every time they raise it, they're amplifying that bogey. Oh gosh!
But the flip side of the coin for conservative investors is that for the first time in a long time, there's real opportunity out there and pretty safe instruments that give you an opportunity to earn interest on your principal. And I think the kind of the simplest version of that we're all familiar with is banking with CDs, right? We've all had them at some point, or been gifted them, or certainly been aware of them. And CD rates are really spiking. And, looking at kind of a current sheet right now, you get a 6-month CD at 3.92, so just about 4% for a 6-month CD. Going to 12 months is 4.4, 24 months, 4.3, and getting out to 60 months, 4.4. And I think what's interesting about that is that, you can see in the rates being offered that the banks are not really certain what the kind of long view looks like here, because the difference between a 6-month and a 5-year CD is about 0.5%.
Yeah, I think when you're talking about CDs and banking and so forth, I mean, what they invest in is so rate sensitive that when you start looking at, hey, we may be in a rate bubble environment, that the longer they go out, the less likelihood they want to commit to big time payments. So that's why you kind of see this very cliff, kind of like you've hit the peak. We know we can pay you for this much for this long, but we don't want to go really past 5 years any higher than that anyways.
Right.
So
the benefit in terms of your portfolio, your retirement, what can a CD accomplish? The question is, consistently put out there, no matter what the rate environment is what can you get me like a CD, but better? Or, meaning guaranteed. Well, what a CD will do is it can protect against market loss. It can also give you access to your money, and it also has a guaranteed death benefit, basically. Those are the benefits there that you have with the CD world. The rate is going to be kind of given whatever the market is. And as we go up in rates, then we're seeing those increases. And like Dan was talking about, the Fed not really knowing, or excuse me, the banks not really knowing too much about what the future holds. You're not seeing a ratio of the rates at a short-term CD increasing at the same pace as the time that's getting put out there. For instance, that 3-year CD to the 5-year CD, only about a half a percent of difference is very nominal, given what's happened in the rate world.
Seth, I would even add to that, and I would say that what's really scary is that these percentages are very, very close to kind of the statistical numbers that people say how much you should be taking out of your portfolio every year to live off of, that kind of 4 to 5% range. And we all know Monte Carlo, which is the kind of statistical odds of how much you can take out, is a lot lower than 4%. With the volatility, because the volatility creates even a more difficult ability to withdraw a consistently higher number out. So. But then you have to take into account that, hey, these rates are higher and inflation's higher. So everything's costing more. So even though these rates are going up, it really doesn't fit the void, honestly, in some of the demand. But it's kind of interesting that, when you talk about some of the income solution planning around there is that 4 to 5% range is what a lot of people talk about.
Yeah. It's going to be interesting to see what happens in the next 6 months as we're projecting to see some more increases. But I don't think the banks are necessarily going to keep up with what those rate increases are. I think they're kind of looking at their crystal balls and saying, I think we're going to see things come back down. And this is really the risk that we're willing to go ahead and take on in terms of rate and this environment. And I think that's what I've seen, at least in the last rate increase as well. It just was not proportionate to what the Fed was putting out there.
Yeah, and I think, that takes us to kind of another product we had talked about, which actually had led a few people to give us to reach out to us and so forth, was actually the fixed annuity, the CD-like world of the annuity space, which, when you're talking about a guaranteed annuity that's a 3, 4, 5 year or 10-year fixed annuity, those rates have gotten extremely aggressive. And insurance companies can be a little more aggressive because they don't have to invest the same way banks do. They don't have the same, rigidity around where they can put their money, how they can place it, the reserves. There's just a little bit more freedom in that, and they can take money in, and there's balances to payouts versus income and what's going on with annuity companies that are different than banks too. But that creates a huge opportunity because, I'm looking at a list of annuities here, and you can get a 5-year fixed annuity right now for 5.4%.
Yeah, it's incredible. We haven't seen rates like that in a long time, and
fixed for 5 years.
Yeah, comparable to the 5-year CD where it's 4.4, right? So it's a full point higher, and the added benefit that's not listed in the rate itself is that it's tax deferred, right? That CD earnings at 4.4% is going to be taxable to you annually, assuming it's not in an IRA. Same product or same length of investment commitment, 5 years in the fixed annuity product, your gains are tax deferred all throughout. So you don't have a taxable event until the end time when you actually withdraw.
Yeah, and obviously annuities are a retirement-based product essentially because you're not taking the money out till you're 59 and a half without penalties. But it doesn't mean you can't move from this annuity product 5 years from now and move to another annuity product later on without having to deal with either the penalties or the taxes. So there's the ability to maneuver inside this space. But when you actually start thinking about the tax deferral and the length, the other thing is you can go out, 7, 8 years, and you could be cresting well above 5.5% even with some of these things. So at that point in time, insurance companies, they can step into the void and say, we can give you a guarantee for much longer because we can use different investment vehicles. They can, they could be buying real estate. They could be buying real estate investment trusts. They could be buying option contracts. They could be buying bonds. They can be buying anything they want out there to literally allow for them to extend this guarantee out for long as people potentially want.
And when you think about it as a piece of a portfolio too, and we always do that, if you can guarantee yourself, roughly 5.5 for 5 years on a portion of your overall portfolio, that's guaranteed. When you're targeting 7 or 8% of it as an average annual return towards your retirement goals, you can put aside a healthy chunk of that money, secure that return, and then be a little bit riskier in whatever the remainder is of your portfolio to try and obtain that 7 or 8%. But usually, if you're investing risky, or in a riskier than usual sense, you're taking on more downside potential there. But when you have the bulk of the portfolio locked in at 5.5, you're much more likely to stay close to your goals. I
was joking around. I don't know if I was joking around with you or with Seth or with somebody, but I was talking about how, some of these it might have been, anyways, it was something, but I was like, well, actually, some of these insurance companies are higher rated than the U.S. government. So you can, it's not like you're just putting your money with some arbitrary company and so forth. These companies are, officially rated and everything else. And I thought that was a funny, where did I say that? Must have been some meeting or something, but it was just kind of funny thinking about that, these insurance companies are higher rated than the U.S. government. That's pretty scary. But something to consider.
Yeah, anytime you're dealing in the fixed world like this, whether it's at the bank or at an insurance company, creditworthiness is always important. And there are many, publicly available places you can go online and evaluate the creditworthiness of any bank or any insurance company. That information is just all out there.
Yeah, and obviously banks are FDIC insured. Insurance, annuities are not. Annuities, you have the insurance pools and the guarantees of the insurers and the reinsurers. But when you really break it down, banks go out of business. There's banks that go out of business every year. Insurance companies just get gobbled up by the reinsurers. They don't really go out of business per se. So it's a different type of kind of backdoor coverage that you would want to look at. But from a rating standpoint, that's really where you want to focus.
Yeah, I was going to say, as far as what the product can offer in comparison to that certificate of deposit, the annuities can offer protected monthly lifetime income. They can protect against that market loss, which is also what the CD can do. They offer tax-deferred growth for retirement and a choice of income guarantees. You can have access to your money, and you can have a guaranteed death benefit as well. So in terms of what is available, they really open up the gamut to you of different kinds of guarantees and access.
Yeah, there's no doubt that the annuity world, because of the competition amongst insurers, frankly, they have a little bit more in the kind of bells and whistles department in terms of additional benefits that you can get beyond just the interest rate. That those aren't really features that exist in the banking world. So if that's of value to you above and beyond just the rate itself, there's certainly a strong consideration to look at. And there's variation there too, Seth. You brought up a bunch of different, what we consider to be living benefits of an annuity. And some may be more valuable to you, the individual, versus others. And that's where, consulting with professionals like us can help steer you towards what makes the most sense for you.
If you're listening to Money on Tap, you can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about safer and safest money today. Just visit a little bit about fixed annuities and CDs and a bit of a comparison there. And as we're having conversations with you, one of the next pieces, or oftentimes it's kind of a lead-in, is, what about bonds? What about those? They're a safe investment, right? And, what are they and how they work? Some people are super understanding of how this goes in terms of, rate increases and different kinds of bonds and different kinds of, investment bond structures. The thing that, just in a highlight from 30,000 foot, as far as what we've talked about with the CDs and annuities, bonds can definitely protect against market loss, if held to maturity. And but they are not a tax-deferred growth for retirement. And there's, really no choice of income guarantees with them. You do have access to your money, but there's no guaranteed kind of a benefit there necessarily with them.
Bonds have been a conversation we've had more of in the last, I would say, couple months than in the last, 5 years, maybe
more,
maybe
10.
longer. Yeah, I mean, no one talks about bonds and hasn't for a long time. So it's kind of interesting when we start getting questions about people with bonds. We go, all right, let me pull those cobwebs out. I mean, the bond world has been so bad for so long. I mean, we even changed our managed portfolios and removed a ton of bond holdings and started putting large high yield, large cap, blue chip, high yield companies in there in exchange just to take the anchor of how bad bonds have been over the last decade out of our portfolios, which helped quite a bit in our returns. It really, really did. One of the things that, we used to talk to people about, I remember saying, I've said on this show, I'm sure, do you want to buy a Pfizer bond paying you 0.5% that's going to give you the same $1,000 you put into it 10 years from now, or do you want to buy the Pfizer stock, it's paying you 2.5% in a dividend with the potential for growth? I mean, I don't think Pfizer's going out of business. It's just not happening anytime soon. So could it happen? Yeah, but it's just not on the radar. Could you lose money in the stock? Yes. Could you lose money in the bond? Yes. They're both risky. Is the bond a safer investment? Yeah, but that's why it pays you less. Right? And so people have to really kind of go through the thinking of bonds. But now as the Fed has raised rates, bonds have become significantly competitive. I mean, bond offerings today and the corporate kind of bond world is paying about a little over 5%, 5.18. So less than the fixed annuity we talked about earlier, more than the CD, but only a year ago it was paying 2.76 on average. I mean, significantly not not interesting.
And we're still, even at the 5+%, we're still below the historical average in that world, which is a little bit over 6%. So, bonds have been significantly depressed for a while. This rate environment that we're in, powered by the Fed, has increased those potential returns or the interest income you can get off of them anyway. But there is substantial risk to your principal still ongoing in there. And we've talked about this in a number of shows in the past, but, as interest rates goes up, the value of existing bonds goes down.
Yeah.
And it's clear as day for the next 3, 6, 12 months, rates will be going up.
Yeah, and I think the easiest way to explain it, though it probably won't resonate with everyone listening here today, is if Dan and Seth both own bonds, and Dan buys a bond for $1,000, and it's paying 2%, right? And it's giving him 2% every year. And 10 years from now, they're going to give him his $1,000 back. And a year later, a new bond's paying 5%, and Seth buys that one for $1,000. And I walk in and I say, hey, and both of them want to sell their bonds. I'm not going to be interested in paying $1,000 to Dan for his bond for 2% when I have Seth, bond that cost him $1,000 paying 5%. I'm either going to offer Seth more money or Dan less. And I think that's the best way to deal with it. So as when the Fed was lowering rates over the past, decade and dealing with all of that and the kind of all the things that happened there and these low rates, people made most of their money on the fact that, they owned these higher yield bonds from long ago and they were selling them for a premium. They were selling them for more money than they paid for them because they were paying more of an interest rate than what was currently being offered. And yet, now we're kind of in the reverse situation where you buy a bond today and the Fed's raising rates. I mean, they've told us they're still going to raise rates. They're going to be aggressive till they get to 2%. And that means that the bond I'm buying today is probably going to be worth less a month or 2 months from now until the Fed's done raising rates. And the person who buys the bonds at the high rates will always be kind of in the money, always be at a premium. And I'll have to wait for rates to come down before I hit par, where it's exact same Fed rate, where my bond is now worth what I paid for it. And then as the rates drop again, well, my bond's paying more of an interest rate, so now my premium's gone up. So, this is important for people to understand, and it can be a little complex, kind of walking through the moving of those numbers and the value of that. But if you just think both investments are $1,000, that $1,000 is not going to change at the end of the day of what is paid to you when you're done owning it. Right? You're still going to get just your $1,000 back. So the only way you can get either more or less is selling it earlier than its maturity date. So it's important to understand that bonds hold that vulnerability for the day in which you want to get rid of it. And you need to make sure that timing and the expectation of interest rates and how things are going to be play into the right situation. And a lot of people are freaking out. I mean, we're we're staring down the barrel of an 8% fixed, 30-year mortgage. I mean, it's basically almost. I mean, we're approaching tripling what it was a year ago. I mean, we're approaching it, and we're probably going to hit it. I mean, I'd say 9% fixed, 30-year rates. I think it's around the corner. I think we're going to be seeing that before the end of first quarter. And I think a lot of people are talking about them lowering rates. Yeah, they're going to lower rates. I don't know if it's going to be as low as it is now. I just don't know because the Fed is so insistent on hitting this 2% inflation mark. And even though we've seen inflation curb to whatever, 5.7 or 6 point, whatever the number was, I can't remember what the report was, it's still way off from 2.
Yeah, substantially higher than that. So there's ways to go. And, the effect of the Fed moves, we talked about it here a couple times just in the show, how that's a kind of a trailing indicator. It's going to make things choppy for a while here before we know whether or not we've been on the right course. And in the meantime, these rates just keep going up.
Great point there, Dan. The comparison that we have across all of these different asset classes is certainly, what is your return? And, the more that we take a look at larger segments of time, the more that we start to use these averages, laws of large numbers start to apply. So one of the things that we use as far as an analogy to try to help us understand, in a kind of a shorter term, the closer that we get towards retirement, that window's getting closer. Let's say you have a river and that river is flowing, and I were to tell you, okay, well, the average of the depth of that river is 3 feet. And that seems like, well, that's totally doable. I can get to the other side of that river. But what if you have, at one point in time, a depth of, say, 20 feet? But the rest of it's just, a couple inches across the water.
And you can't swim.
From side to side. Yeah. You're not getting across that river, right? So that's one of the things that as we take a look at, the comparison, a lot of the times these bonds get compared to indexed annuities, because there's opportunity inside of those indexed annuities, versus some of the other ones. But the comparison that doesn't get drawn into here is, yes, you have that opportunity, but with that indexed annuity, that average depth of the water of that river that you're trying to cross, that gets satisfied because it will never, the floor is there. The depth is never going to get beyond what you can forge.
Yeah, it's a good analogy in this respect because of the feature of the index annuities. The most important thing, the most comforting thing, and the part of it that we tend to rely on as planners is that regardless of what happens in the market, you will not lose money due to a downturn in an index. So it's just a really significant element of building a plan that matters, and why, particularly for retirement dollars, these make a lot of sense. And on top of that, every year that goes by, which is a gain, that gain gets recorded and locked in, and that's now your new floor. So it doesn't have some of the upside potential necessarily of being directly in the market, but in a situation like we're experiencing now, there's a lot of value in appreciating and understanding how that safety mat works, right? That floor value that's built in and the principal protection that's offered are incredibly valuable. And that goes into how an index annuity is built. And this can get a little bit complicated because people will look at the brochure, we'll have a conversation around, how these things work, and we'll start talking about caps on an index, typically the S&P 500. So it's an easy takeaway for someone who doesn't understand these maybe as well to say, well, my money's in the S&P 500 because you've heard that. The truth of the matter is, though, that the insurance companies that offer these types of products are not putting your money in the market. They build the index annuity with a bond portfolio that they select, lots of U.S. Treasuries, but they have the ability to mix in corporate bonds as well, and then an options portfolio, which is a complicated investment product that essentially is making bets on which way the index is going to move, but they have a way to build these complicated strategies with the option tool that makes the outcome predictable for them no matter what happens in the market, right? So that their exposure of loss potential is defined. And really what they're trying to do is essentially break even in this options portfolio and gain from fluctuations that occur within and the costs that they put into buying these option tools. So essentially when you're buying an index annuity, what you're buying behind the scenes is a well-managed bond portfolio. So that's why it's important to note that your money, if you consider an investment like this, is not in the market, but your returns that you receive from the insurance company will be based upon what the market itself does. So that's how they're actually able to truthfully tell you that your principal is guaranteed and you will not lose money if the market goes down, simply due to the fact that your money's not in the market.
Yeah, I think one of the things that people get, concerned with when it comes to annuities is just the illiquidity or the weight to 59.5. But the truth is, and I love Seth's illustration of the river. I think it's literally the absolute best scenario you can possibly really put in perspective. You can't swim, you're trying to cross a river, and you're like, oh, this is only a couple feet deep, and all of a sudden you hit a 20-foot void in the middle of the river and you're dead. I think people don't understand that, that comes with market risk. And I think with interest rates and so forth, you could put $1,000 into a bond today and you have no liquidity because rates continue to go up, and your bond is worth half as much money. I mean, that could happen. That could really be the case because that's what happened back in the 70s. People, there was lines for cars at gas. I mean, we're talking about very similar kind of approaching scenarios. We're talking about running out of diesel in our country. I mean, is that true? I don't know, but the fact that we're talking about it is a problem. That concerns me. So when you start talking about things that have happened in the past and those fears, you start walking into that stuff where, at least with the annuity, you have the downside protection and the windows of liquidity that create that, even though it's an entirely illiquid investment. Yeah, bonds are fully liquid. So if you need that liquidity, hey, that's going to play a major player in that piece. But for years, we have been talking about how fixed annuities or indexed annuities could play and do play as a potential bond alternative, and have actually done very well in comparison in the average portfolio performance.
Folks, we're talking about safest in your portfolios and your retirement. It's an awesome topic. We're having a lot of fun with it today. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're going to take a quick break. We'll be right back.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about safer, and safest in terms of the investments that are available to you out there, and how do you do some of these different investments in your portfolio. We're going to take a look at some different returns. We've talked just a little bit about taking a look at the river. The river's, out there in front of you has, like, say, a historical performance or return of, whatever that is. And let's say that river's 3 feet deep. Well, there might be about a 20-foot depth somewhere out there that you're just, it's there. You don't know when it's going to happen. But for you to get across that river, you've got to have something that's going to allow you to go ahead and get clear across the river. You need a floor, ultimately, right? You need a depth that you can understand and you can navigate no matter what. And that is one of the things that the annuities can provide inside of your retirement. However, if we can still have, returns, what do those look like? How do we understand them?
It's returns, right? I mean, that's the question of the hour. The S&P 500, since 1997, total return is about 9.29% to March 2022. When you start looking at like the Treasury and compared to that, the single A bonds and the kind of the indexed annuity side, where it's a volatility index, which is the one that usually performs the best historically. It's interesting. The S&P is 9.29 and the Treasury is about a little over 5%. The single A bonds are just a hair better than that at 5.14%. So barely nudging above the Treasury. But the fixed index annuities approaching 7 with, basically a bond-like portfolio, and it's adding the diversity of the market and potential returns, but that lower risk piece, the kind of the downside protection of not losing money in the index annuity, has really created that that bump up in the actual total return space.
Yeah, if you look at how some of these different index allocations work within the annuities, and you compare them to a bond, right, and that's where these things potentially make sense. And I wouldn't say it as a blanket statement for everybody, but if you consider an index annuity, you've heard about it, somebody's presented to you as an alternative to being in mutual funds or being in equities in general, that's really not
it's not the same thing.
No. It doesn't offer the same features, same potentials, and it really is a different thing. The real comparable, is to the bond world, right? So if you think of it that way, and that's kind of the appropriate way to do it, and you consider where history tells us returns have fallen, if you're using an S&P capped type of an index annuity, which is very, very common, you're going to beat, or you have beaten in the last 19 years, the average bond return. This is a single A, so highly rated bond, 51% of the time. If you consider the volatility control indexes, which exist in most of these contracts, you're actually going to beat that single A bond 98% of the time.
And I think that's the numbers that people need to hear, because there's a lot of people out there that will sell index annuities who are just insurance agents. And I don't mean to mock that concept, but don't understand the investable comparison and what they're really for, because they're trying to compare them to get yourself out of the stock market but have the stock market. And that's not really what the conversation is when it comes to index annuities. It's really just saying, I'm seeking a lesser return, potentially. I'm reducing my risk. I'm reducing my opportunity, but I'm trying to, mimic returns better than the bank with as little risk as I possibly can. And so when you start engaging that conversation and you start looking at, hey, I want that, and this is retirement funds, well, now the annuity conversation comes into play, and it becomes relevant. But, unfortunately, we've seen a lot of people in this world take a square peg and try to shove it down a round hole. And, there's been a lot of people who have just not been happy with their purchase because they didn't understand what they were buying. And they didn't understand what the point of that investment was. So when you make, 10% in your index annuity one year because the stock market's rocking, doing 40, and you're angry at your insurance agent because you didn't do the 40, well, that's why you really bought a bond. And, that's the thinking you should have. And when you buy bonds, you buy CDs, you're not thinking you're going to get stock market returns. And that's because they've been sold wrong, they've been communicated poorly, and they've been put in the wrong position. But with this conversation, if you're looking for, hey, I'm really excited about what the fixed world has to offer, well, the annuity space is really amplifying that when it comes to retirement. And as you said, Dan, 98% of the time, it's beat it.
If you're looking at this rate picture and you're saying all of a sudden for the first time in forever, hey, potentially I'm a bond investor, consider this, we can give you, or likely we can return the same type of actual return that a bond would offer. But in addition to, you can get something like a guaranteed lifetime income stream. You can get annual free liquidity. You can get nursing home benefits. You can get death benefits. You can get all these other features that no bond out there offers, and have a realistic chance of being in the same return space.
And I think a question you can ask somebody is, have you ever built a bond ladder for somebody? Because I'm talking, and I have. I build bond ladders. It's not like I don't have there's no offensive scenario to a bond space. We actually do that work all day, every day. Not an issue. But when it comes to conversations about alternatives, you got to evaluate that when it comes to retirement.
Yeah, there's just so much to be offered inside the conversation in and around these safer and safest opportunities for your money and for your retirement portfolio. Are you looking for protected monthly lifetime income? Can you protect against market loss? Do you have a choice of income guarantees? Can you access your money? You have a guaranteed death benefit. All of these things matter to you, and they matter to your money. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@moneyonTap.com. yourmoneyontap.com. Make it a great week, folks.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.